Who just joined us? Were any of those who just joined us a committee member?
Hi, Sashin's here. How are you doing?
Great, thank you.
Hello, this is Kevin Mahoney from Anthem.
Thank you. Is Mr. Nimmer on? Or Mr. Young? So we do have a quorum.
John, why don't we
go ahead?
Why don't we go ahead and take roll?
All right. Mr. Mahoney?
Hello, this is Kevin Mahoney.
Mr. Mahoney is here via phone. Mr. Nimmer? Mr. Nimmer appears to be absent at this point. Mr. Shaw?
Present.
Is here via phone. Mr. Young? Appears to be absent. Mr. Tompkinson?
Present.
Is here via phone. Vice Chair Campbell indicated that she would be running just a few minutes late. Madam Chair?
Present.
And we have a quorum.
Thank you. This is Leslie Johnstone, and I'll act as the chair for the Risk and Reinsurance Subcommittee of the Silver State Health Insurance Exchange. And at this point, I will open it up to public comment if we have any in Carson City.
None here.
Thank you. Do we have any public comment in Las Vegas? None at this point, John.
And would you like to ask for public comment over the phone?
Yes. Any public comment from the phone? All right, thanks. We'll move on to item number 3, which is approval of the minutes from the March 9th and March 29th advisory committee meetings. Anyone have any comments on the March 9th minutes? John, I would just, I think it's a typo. Item 4, the sub-bullets start with E, and I think they should start with A if that's how the agenda was labeled.
Okay, we'll fix that.
Any other comments on the March 9th minutes? Is there a motion to approve?
Motion to approve.
Can you state your name for the record?
Charles Tompkinson, motion to approve.
Thank you. Is there a second?
Second, Sashin Shah.
Thank you. So we have a motion and a second to approve the March 9th minutes. All those in favor say aye.
Aye. Aye.
Aye.
Any opposed? Thank you. Motion carries. So then the next item is the March 29th minutes. Anyone have any comments on the minutes for March 29th? John, I would have the same, I think, typo correction on item 4 if it matches the agenda.
Okay, we'll fix that.
Did we happen to have a subcommittee member join on the phone?
Yes. Good morning. This is Tim Nimmer. How are you?
Thank you. Good morning, Mr. Nimmer.
Good morning, Ms. Johnstone.
March 29th, if there are any other corrections to the minutes? If not, is there a motion to approve?
Sashin Shah, motion to approve.
This is Patrick Young.
Thank you. Is there a second? Thank you. All those in favor say aye.
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 Those opposed? Thank you.
Madam Chair, who is the second?
It's Patrick Young. I just called in.
So, and let the record reflect that Ms. Campbell is now here in Carson City. So we have 5 members via phone, Ms. Johnson in Las Vegas and Ms. Campbell in Carson City now.
Thank you. So that'll bring us to item number 4, which is a review of the status of the work completed by the committee, and I will turn that over to Mr. Hager.
For the record, John Hager, item number 4 is a review of the status of the work completed at this point. We had 2 meetings that we just approved the minutes for on March, 9th and 29th or something like that. The items on the calendar are the items that are under review today. We discussed briefly at one of the previous meetings that we would do a review of the items that could potentially be used for Nevada-specific conditions, and I think the report provided by the Division of Insurance today will address those items fairly well. On page 2, you can see the regulations. If you want to look at the regulations, you can go to those links and view those. And then a summary of risk adjustment and reinsurance. At this point, we haven't made any specific recommendations. Hopefully, we'll get some good recommendations out of the committee today. And with that, I'll be happy to take any questions.
John, this is Leslie. On page 2 and 3 at the last paragraph of the risk adjustment section, and then under the committee recommendations approved to date, it refers to the meeting in Washington as upcoming rather than having already occurred. Is there anything to report at this point from what you learned at that meeting, or is that embedded in the Division of Insurance report?
That will be provided in the information provided by Ms. James.
Okay, thank you. Any other questions or comments from the board on item 4? Thank you. And do we have Ms. James at the dais? Yes, thank you. All right, so that brings us to item number 4, which is discussion and possible action regarding the following items as they pertain to the Permanent Risk Adjustment Program, and that's the analysis of the federal risk adjustment models and whether or not the state should develop its own an alternate risk adjustment model, including potential use of federal model with state-specific parameters, or defer to the federal model, and the data collection methodology. So, John, unless you have any comments, I'll turn it over to Ms. James with the Division of Insurance.
Thank you, Madam Chair, members of the committee. For the record, I am Annette James, lead actuary with the Nevada Division of Insurance. I will lead us through the division's report regarding risk adjustment and reinsurance programs under the ACA. And I will be using the 25-page report that we provided to the committee. So first of all, I want to mention that the report is draft, in the draft form, because we're waiting on clarification in certain specific areas from HHS. We've actually been communicating with them quite a bit. I think we had 3 conference calls within the last 2.5 weeks, and there are a few areas where their input would be helpful in clarifying some of the options that are actually available to us as we make these decisions. So because some of these items may impact the decisions made, the report is actually in draft form. And as I go through the report, I will point out these areas so that the committee is aware of the areas that may change. Oh, secondly, our internal DOI team is currently doing research on certain items that may also impact the recommendations to the committee, and both with respect to the HHS input as well as our internal DOI research team input, those are specific to the reinsurance program. So as I will get to later, you will notice that some of the recommendations are tentative at best, and in one case we actually deferred or punted a recommendation. So now I will start. Essentially, our report is 25 pages, but the first 2 to 5 pages, pages 2 to 5, are the executive summary, which really gives an overview of the report. What I will do is kind of lead us through the report. I apologize that it was not available before Friday. We had planned on providing it before that, but we were hoping to get final information from HHS in particular, and so we were down to the wire on that. Again, I apologize.
Ms. James?
Yes.
This is Leslie Johnstone. Can I ask that you kind of break up the presentation between the risk adjustment and the temporary reinsurance program so that we can maybe take action on one and then move to the next so we're in sync with the agenda?
That would be fine, Madam Chair. Also, would you like me to pause between, as we get to each of the decisions, to get feedback from the committee, or would you like me to go through all of the decisions for, say, risk adjustment before getting feedback?
How about if we go through the full section on risk adjustment, and then we'll stop and have a thorough discussion?
Thank you, Madam Chair. That's what I'll do. Okay, so as an overview, the Affordable Care Act, which I'll refer to as the ACA, it really reflects a paradigm shift with respect to health insurance. There's some of the market reforms, particularly the guarantee issue provisions, and also the rating rules included in the Affordable Care Act really changes the rules by which carriers operate. These changes really put an upward pressure on premiums and increases the uncertainty with regards to particularly previously uninsured individuals coming into the market for the first time, and there being not a whole lot known about the risk profile of these individuals. All of these forces can result in, as I said, upwards pressure on premiums, and maybe carriers deciding not to enter certain segments of the market, including maybe the exchange. And so the DOI's role is to try to ensure a stable, vibrant market so that consumers will have choice with regards to health insurance products. The risk mitigation programs included in the ACA also try to address this uncertainty and mitigate the risk associated with the change in the health insurance environment. So pages 6 to 8 provide an overview of the risk mitigation programs under the Affordable Care Act, and particularly I want to bring your attention to Table 1, which is on page 7, and this really kind of illustrates one of the reasons why we should really pay a lot of attention to these risk mitigation programs, and that is the difference between the rules of the rules in the health insurance market in this state compared to the new rules under the Affordable Care Act. This table really illustrates that there will be a big change, especially in the individual market, and that could lead to destabilization. So the risk mitigation programs that are intended to address the premium stabilization, risk mitigation, are more important in our market than perhaps other markets such as New York or Massachusetts, where a lot of these reforms are already in place. Table 2 on page 8 gives an overview of the Affordable Care Act's 3 risk mitigation programs, and I don't plan to really go through these in detail. We've already kind of covered a lot of this in 2 previous meetings. When we get to reinsurance program, I'll go into a little more detail because in those 2 previous meetings, we really haven't had a chance to explore that program as much as we've had the opportunity to talk about the risk adjustment program. If that's okay with Madam Chair, I'll just keep going on.
That sounds very good. Thank you.
Okay, now we come to the risk adjustment program, which is discussed on pages 9 to 10. Again, we've already discussed this in quite a amount of detail in the last 2 meetings, but just as an overview, figure 1 on page 9 really illustrates the payment transfer process. Just to jog everyone's memory, the risk adjustment program really transfers funds from those plans with with healthier individuals and transfers those funds to plans with less healthy individuals. The point of this is to allow or encourage insurers to price based on quality and price rather than the ability to attract a favorable risk profile when it comes to enrollees. Now, one of the unique features of this program is that it's a zero-sum game. What that means is that the amounts of payments into the program should be equal to the payments out of the program. And this is a unique feature of the the risk adjustment program under the Affordable Care Act. The other risk adjustment programs that are in place right now, for example, for Medicare Advantage program and also Medicaid programs, those are not zero-sum. They're not budget neutral, they're not zero-sum. So this is one of the features that provides unique challenges as HHS and also states try to implement this program. Page 10 also gives an example, actually 2 examples of how risk scores are calculated under the risk adjustment program. And so just to give a little background, essentially a risk score is calculated for each individual in the system, and that could be based on a combination of facts, demographic information such as age, and then health status with regards to the person's experience as far as different health conditions. So with example 1, you can see how a risk score of 2.80 is calculated for this individual. And what that means is for this, the first example, compared to someone with average health risk, this person is 180% less healthy than the average. And going on to example 2, that person is 78% healthier than the average. With regards to example 2, I want to point one thing out which I will mention, which will be of interest and make more sense as I go through the report. But one thing I want to point out is in example 2, this could be a healthy individual age 32, or it could be someone with no medical history. And that's one of the challenges as the risk adjustment program is being implemented, because due to the guaranteed issue provisions included in the Affordable Care Act, we may have the experience of seeing quite a few people with a profile of example 2. That may not be indicative of their actual health status. So as we go through the report, I will point out where this will be important as we consider the options. Moving on to page 11, I will then now talk about the key decisions for Nevada with regards to risk adjustment, and this is pages 11 to 17 is what we'll be looking at. So one of the key things that we need to kind of take into consideration as we look at these decisions is that a state electing to administer the risk adjustment program has to indicate on no later than November 16th of this year the risk adjustment entity that will be administering the program, and also whether the state is planning on using a federal risk adjustment methodology. So that will indicate if a state decides to administer the risk adjustment program, that will give HHS the information that it needs to indicate that the state, at least for risk adjustment, is ready to move forward and will meet the deadlines that are included in the Affordable Care Act. Okay, so now on to the first question. And one thing I want to point out is that in the summary, the executive summary, the questions that we'll be addressing is in a slightly different order than the order that that I present in the report, and there's actually a good reason for that. For the executive summary, we felt it was important to get to the question that everyone wants to know. What do we think of administering the program as a state or deferring to the federal fallback? And but when we're going through the report, we wanted to kind of walk the committee through our thinking process. And some of the decisions that we would make as a state if we did administer the program really leads us directly into our recommendations. So we felt it was important to explore the state-based administration of the program, and that will lead naturally to the decisions or recommendations of the DOI with regards to risk adjustment. Okay, so the first question is, assuming that Nevada administers the risk adjustment program, which entity would be best suited to administer it? The final regs give us essentially choices And they are either the state's health insurance exchange, a state agency such as the Division of Insurance, or the state's Medicaid agency. And then an entity other than a health insurance issue which is incorporated in at least one state and has demonstrated experience on a state or regional basis in the individual and small group health insurance markets and in benefits coverage. So as we discussed in our two previous meetings, in determining the state entity best suited to administer the risk adjustment program, we felt that the following considerations should be taken into account: the alignment of the risk adjustment regulatory function with the mission of the entity, the potential conflicts of interest, experience in the commercial, individual, and small group markets, authority to regulate the entities, ability to carry out the functions, experience administering risk adjustment programs, and the leveraging of existing resources. Now, notably, there are two areas that I did not include in the report as far as considerations in choosing an appropriate entity. And these two considerations are the cost and the strain on existing staff, particularly existing staff in state agencies such as the exchange, the DOI, and the Medicaid program. And the reason is that it's expected, no matter what agency, if it is a state agency, took on this responsibility, it would be a strain on resources, it would cost, and the cost would not vary greatly between depending on which agency took on the responsibility. So that has been excluded from the analysis here. The considerations are summarized on Table 3 on page 12. And as you see, so as far as risk adjustment functions aligning with the main mission of the entity, I guess the one change I would have is under the the column for the health insurance exchange. I said no, it didn't align. Actually, I am not certain because it depends on where the exchange ends up as far as their mission. Is it a pure marketplace, or is it takes on more of a regulatory role, or something of a hybrid? So based on Table 3 and the number of yeses that are in each column, it came very quickly to the conclusion that the best entities based on this analysis to administer the program would be either the Division of Insurance or a brand new entity established in accordance with the Affordable Care Act. However, and so that comes to our recommendation on page 13. However, what we looked at is for a new entity will actually need to be overseen by a state agency, and probably the best choice for that will be the Division of Insurance, just because of its regulatory authority over the carriers. So the thinking is that creating a new entity for this purpose will really result in just an additional bureaucratic layer with potentially higher cost and not much additional benefit. So for this reason, we recommend that the Division of Insurance should be the entity administering the program, keeping in mind that in order to carry out the functions required, that the DOI will probably need to outsource most, if not all, of the administrative functions. The next question that I'll address is, again, assuming that the state administers the risk adjustment program, should we use the federal methodology that has been, or actually is currently being defined by HHS, or should we develop a state-specific alternative? In order to address this question as to the federal methodology, we thought it would be important to focus on at least a couple of areas regarding the technical capabilities or the technical aspects of the methodology that the federal program contemplates. And this is where I will stop for a second and mention that the federal methodology, there's still a lot of areas where we're not sure what HHS plans to do, but the basic framework of the federal methodology was released in a public meeting in May 7th and 8th. And that's, I believe Mr. Hager referenced that earlier. And that's where we got a little more insight as to what HHS was thinking. So based on that information, what I'd like to do is walk through a couple of the decisions that HHS has made regarding the methodology. And I'm now on page 14. And analysis of those decisions really helped us form our conclusions regarding the recommendation as to whether the state or the federal administration of the program is appropriate. So first, pardon me, I'm on page 13, the bottom of page 13. First is the choice of a statistical risk adjustment model. That's really the software that will drive the calculation of risk scores. Essentially, HHS decided to use a hierarchical condition category classification system, HCC, and this is currently used in a Medicare Advantage risk adjustment model. When we were thinking about this, the DOI is comfortable with the HCC model, noting that there would have to be changes made to that model to at least the Medicare Advantage version of the HCC model to reflect the population that would be affected by the Affordable Care Act as opposed to Medicare. So the question at the last meeting essentially came down to, when we talked about the federal methodology and particularly the federal model for risk adjustment, was, is this state different enough from the other states to justify the development of a state-specific risk adjustment model that will compute the risk scores? That's a really big question, and that's really something that has been concerning me and the division as we try to figure this out. And during a recent phone conversation with HHS, they indicated that they looked at the data, at nationwide data, and could not find significant evidence to suggest that any state was different enough that a different model would be indicated, or different calibration of the federal model would be necessary. So in light of a lack of additional evidence to the contrary, we'd have to go with HHS representation that Nevada is in line with the rest of the states. Then we come to another question regarding the use of prospective or concurrent methodology with regards to the data that's used. And this is also another question that came up at the last meeting of this committee. Okay, I'll get to the consensus in a minute. The federal methodology, which was revealed in May 7th and 8th meetings, includes the use of concurrent data to develop the average actuarial risk. And what that means is that the federal model for 2014 will use information based on the year 2014 to develop the risk scores. The alternative approach, which the final regulations allow states to adopt, is the prospective approach, which means that you can use for 2014, you can use 2013 data to develop the risk adjustment results for 2014. Now, as we think about this, the prospective approach, which uses the prior year information, can be successfully used in states that have already adopted many of the reforms of the Affordable Care Act. And also it may be appropriate, years down the line as these reforms have been implemented for a while, and the prior year's information would be a good indicator of the following year's information. Since we have one of the highest uninsured rates in the country, and we have not implemented any of the of the market reforms included in the Affordable Care Act, it's essential that the risk adjustment program, at least in the first few years, use the concurrent data approach. And that was the consensus, as I recall, of the committee at the last meeting, because of exactly that, the concern that 2013 in particular would not be representative of the population and the risk profile that we'll be faced with in 2014 after the influx of newly insured, previously uninsured individuals. The last issue that I would address is the data collection model. And so the federal methodology, again, which was released during the May 7th and 8th meetings, the federal methodology for running risk adjustment includes the use of a distributed data collection model. And what that means is that the data would be summarized before it's transferred to HHS. Now, again, states choosing to administer the risk adjustment model can decide to use a distributed approach or to collect detailed member level data, which is often referred to as a centralized approach. Alternatively, they can also use an intermediate approach, which is an intermediate approach between the distributed model and the centralized model. There are pros and cons to the use of both models. The collection of member-level data really increases the accuracy of the data and of the risk scores that result from the risk adjustment model. However, it raises a lot of privacy concerns. And so the federal methodology, which includes the distributed data, addresses those privacy concerns. And the data will be encrypted, and so only the carriers will be able to identify individual members. And the DOI thinks that this is an important provision, this is an important issue, and so we agree with the distributed approach, at least in the initial stages of the implementation of the Affordable Care Act. So although there are many other aspects of the federal risk adjustment methodology that have not yet been finalized, the division believes that based on what we know now, we are in a position to make a recommendation as to whether the federal methodology should be sufficient or if a state specific methodology would be required or preferred. And so what we've come to the conclusion that based on the information we know now, we recommend that the federal methodology should be used at least for the first few years after the full implementation of the Affordable Care Act reforms. And then, we also recommend that the federal methodology should be monitored so that we understand the efficacy of the model, and so we can determine later on if a state-specific model is warranted. So coming down to the big question of the day, should we administer the risk adjustment program or defer to federal administration? There are several aspects that we looked at: state control flexibility, timing, availability of state resources, cost, and uniformity. And essentially, what it came down to is that in some of the feedback that we got from a couple of from the previous meetings of this committee, uniformity was a big consideration. Multi-state carriers indicated that the uniformity of approach in risk adjustment was really a very important factor, at least in the first few years, when uncertainty was at its highest. And since HHS will be administering risk adjustment for all the states with federally operated exchanges, and also some states with a state-based exchange, some are saying that HHS will actually be administering risk adjustment for upwards of 30 states. Therefore, deferring to the federal administration of risk adjustment would provide multi-state carriers with a uniform administration that it values. Now, one of the things, as we look at both of these programs, one of the things we have to keep in mind is that for these risk mitigation programs to really work, at least in the first couple of years, the buy-in from the insurance carriers is really paramount. It's really important for them to believe that these risk mitigation programs will do what they're intended to do. And so with the endorsement of the carriers, especially in the area of uniformity, we think it's really important for, at least in the first few years, that the Nevada defer administration of the risk adjustment program to the federal government. And the other big consideration here was looking at the federal model, and the decision that, or the recommendation that the DOI came to, that even if the state administered the program, the federal methodology would be recommended at this point. So with those two, I think those are the top two considerations, as well as the timing. A decision needs to be made essentially by mid-October, and then if a state were to implement the risk adjustment program, we would have to submit a state-specific model for risk adjustment by mid-November. Based on the uniformity considerations, the methodological considerations as far as the federal model as opposed to the state model, and also timing considerations, based on those three, we recommend that the federal administration of the risk adjustment program is appropriate. Madam Chair, I will take a break here as the committee considers these recommendations.
Thank you very much, Ms. James. Very thoughtful report. I'm going to take comments from the board, but first I would like, or from the advisory committee, but first I would like to see if there are any comments from the public in Carson City.
Nothing in Carson City.
In Las Vegas, do we have any public comments? And how about on the phone? All right, hearing none, I'll open it up to the advisory committee for discussion.
Annette, Sasheen Shah here. How are you today?
I'm doing well, thanks.
Good, good. I know that one of our motions was to actually engage outside actuarial to help us in this assessment. I think what you laid out is clear. It makes sense. It's actually consistent with the way I'm thinking about it. But did we actually ever engage outside actuary to help in this determination?
No, we did not.
Okay.
Once the federal methodology was revealed during the meetings on May 7th and 8th,
Yep.
it was really clear to us that it will be an extremely heavy lift to essentially mimic what HHS has been contemplating for the past year and a half or so. And once we got kind of affirmation that there was no real indication that the state was very much different from the rest of the country, we decided that an analysis at that point was not necessarily indicated. Now that said, we've included in our report that the fact that we have concerns over regarding the federal implementation of this program, and the concerns really surround the availability or the access to information regarding risk adjustment by the states. HHS has indicated that apart from publicly available information, the states would not necessarily get any information from HHS, and we have challenged that notion, particularly because risk adjustment and risk scores, average risk scores by plan and also statewide, are really important to carriers as they try to price their products, and to the division as we review as we do a rate review, a review of the premium rates that are submitted to us. There are probably other reasons that other areas that would be helpful to us if we had detailed risk adjustment information from HHS, but that's really one of the key concerns. So as part of this recommendation, we would need to find a way to access information that would be helpful to the carriers and to the division, especially during the first couple of years until information from the federal program would be available. So that's the one caveat. That's our big concern, and we trust that we'd be able to work with carriers to figure out a way to resolve that issue.
I have a follow-up question to that. So you've noted multiple times the lack of transparency, the lack of data, lack of information from the federal government, yet it hasn't changed your recommendation to go that route without further consideration. I just want to make sure that we're clear. Is your position that even though with those unknowns, you still want to travel down the road of adopting the federal model and then looking at potentially changing or breaking away in the future? Or are you recommending to adopt maybe in the short term, but definitely change as quickly as possible if the information is not flowing as you expect and the transparency is not where you expect it to be over the very short term?
For the record, that was Tim Nimmer. Go ahead.
Okay, thank you, Mr. Nimmer. Pardon me, Mr. Hager. Mr. Nimmer, let me try to answer your question this way, and please let me know if I don't adequately respond to your question. The recommendation is that we go with federal administration of the program, and we are noting that we do have some concerns. However, with the timing aspect, it is fairly impossible for us to contemplate a state-specific state administration of the program. Now, that said, I want to clarify that what I'm also recommending is that we monitor the federal risk adjustment program to make sure it's doing what it's supposed to be doing. And we could also contemplate running a risk adjustment model side by side without actually transferring any payments to understand some of the drivers behind the risk adjustment model and the information that's coming out of the risk adjustment model. So after that analysis, it is possible that we will change our recommendation that state administration may be more appropriate. It would depend on a lot of factors that are currently unknowns right now: the cost of state administration versus federal administration, the data collection models that we use. If there's for example, if there is if the state decided to implement an all-payer claims database, which would allow us to use a more detailed and, as I mentioned before, more accurate approach to developing these risk scores. Things like that would impact the recommendation. But for now, based on what we know, given that there are a lot of unknowns, the recommendation is for federal administration. Did I adequately address your question?
Yes, thank you.
Ms. James, this is Leslie Johnstone. If we move forward with the recommendation as a state and issue the letter to federal HHS in November, is there no turning back after that point until the next calendar year? How often when will we be doing the look back to decide if we are satisfied with the model that we went with?
Thank you, Madam Chair. That's a good question. HHS has not been definitive as to exactly when we could relook at that. However, every March 1st, the the state, if a state is administering the risk adjustment program, that will be the deadline by which the state-specific parameters would have to be published. Now, prior to that, the state-specific model and parameters would have to be approved by HHS. So I would anticipate that should we contemplate changing administration to a state-based administration of the risk adjustment program, that would happen. The earliest that could happen is sometime in 2014, and on a rolling basis after that. That would be my best guess.
Thank you. Is there any other questions from the advisory committee members?
For the record, this is Kevin Mahoney. Thank you, Ms. James, for this analysis. One question I did have, by deferring to the federal risk adjustment methodology, does that also mean adopting whatever the federal method would be for risk adjustment data validation, or is that outside of the scope of this recommendation?
Thank you, Mr. Mahoney. If the program is administered by the federal government, then all decisions will be made by HHS. The state will have no input. There is no flexibility whatsoever. Regarding your question on data validation, the data validation methodology will also be administered by HHS.
Okay, thank you.
You're welcome.
Any other questions from the advisory committee members? I have a question for, I think, Mr. Hager. Any action of this advisory committee is going to be brought forward to the full exchange board in September. And is it correct that then that's the recommendation to the Division of Insurance for which action the state could take, so that action of the exchange board is not the final decision of the state, but that will bubble up through the Division of Insurance?
For the record, John Hager, that's correct. The last section in our statute says that we cannot impede the ability of the commissioner to regulate insurance. And because this affects both insurers inside and outside the exchange, I would hesitate to recommend the board provide any concrete final, this is how we're going to do it, and that it's really a recommendation to the Division of Insurance. Furthermore, the declaration that will have to be provided by the governor at some point by November 16th to determine whether it will be a state-based or federally facilitated exchange and whether or not we administer the reinsurance and risk adjustment programs. That will be signed by the governor. So ultimately it is the commissioners and the governor's decision on who does this.
All right, thank you. So unless there's additional comment from any of the advisory committee members, is there a motion regarding the recommendation from this advisory committee to the exchange board?
Sasheen Shah, motion to approve.
This is Kevin Mahoney. I'll second.
All right, thank you. So that's a motion and a second to approve the recommendations provided in the Division of Insurance report. All those in favor say aye.
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 Aye. Aye.
Any opposed? All right, thank you all. John, do you need anything else on the risk adjustment program for the September exchange board meeting?
Madam Chair, I do not, although one person dropped off the phone during that discussion, so it might be prudent to take a roll call vote to make sure we know who's still with us. Or, I mean, not a roll call vote, but roll again, just to make sure that going into the next discussion, if we've lost a board member, we know who it is.
All right, so let's revalidate the attendance. John, if you can take roll.
Mr. Mahoney,
I'm here.
Mr. Nimmer,
Here.
Mr. Shaw,
Here.
Mr. Young, Mr. Tompkinson,
Here.
Vice Chair Smith, or Campbell, excuse me,
Here.
and Chair Johnstone.
Present.
So it appears that we lost Mr. Young sometime during the response to Mr. Nimmer's question. Thank you.
All right, thank you. So let the record reflect that in the vote. All right, moving on to item number 6, which is discussion and possible action regarding several items involving the temporary reinsurance program. And unless John has introductory comments, I'll ask Ms. James to continue on with her report.
Thank you, Madam Chair. For the record, again, Annette James, lead actuary at the Nevada Division of Insurance. So let's go on to the transitional reinsurance program, and on pages 18 to 20, we have a summary of the transitional reinsurance program under the Affordable Care Act. And as a reminder, this program is designed to protect all non-grandfathered health insurance plans in the individual market from risk associated with insuring specific high-cost individuals. I will go into this in a little more detail than I did the risk adjustment program, simply because in prior meetings, the risk adjustment discussions took up most of the time, and so we really have not had a chance to explore the reinsurance program in great depth. So this program is actually a lot simpler to administer than the risk adjustment program. In fact, it's really a stop-loss insurance program, and it's intended to provide a layer of protection below the level of protection afforded right now by reinsurance contracts for health insurers. First, let me talk about the administration of the program. Under the final federal rules, any state, including those with exchanges administered by the federal government, all states may elect to establish a reinsurance program. And the reason this is important is with the proposed regulations, required states that had a state-based exchange to administer the reinsurance program. So this is actually the final regulations really was a shift in direction from the proposed regulations. So states thought that if they were implementing a state-based exchange, they had no choice but to administer the reinsurance program, and now we do. And for full disclosure, we were one of the states that requested flexibility from HHS as far as administering a reinsurance program. So I guess we got what we asked for regarding flexibility in this area. So a state that chooses to administer a transitional reinsurance program will be required to contract with or establish a nonprofit reinsurance, a reinsurance entity to administer the program. And the regulations are really not specific as to exactly are there any parameters within which a state needs to act in defining an appropriate reinsurance entity. As far as funding, the transitional reinsurance program requires all health plans, including fully insured and self-insured plans, to pay into a state-based reinsurance model and reinsurance pool, and that is regardless of as to whether the pool is administered by the state or by the federal government. So everyone is required to pay in. And how much do they pay in? Well, it's a federally determined assessment that will be used to pay reinsurance benefits. And if you look at Table 4 on page 19, that summarizes the national assessment levels specified in the Affordable Care Act for 2014, 2015, and 2016, a total pool of $25 billion that will be collected from all health plans. Now, one of the things that we have in this report that I'm not sure of the actual validity of it because after talking with HHS, that is not something they have actually finalized. And that is at the bottom of page 18, I indicate that HHS will publish the actual per member assessment rate in October 2012. The point of ambiguity is whether it really is a per member assessment. The national rate will be determined on a per capita basis, but HHS has not yet determined exactly how that once an assessment is allocated to a state based on per capita numbers, HHS has not yet determined how that will be allocated among carriers or among plans. So that's one area of clarification that I was hoping to get before finalizing this report. So Table 4 shows that how the breakdown of the $25 billion what that will look like over the next 3 years, and between amounts that are slated for payments of benefits under the Transitional Reinsurance Program and under the and that will be allocated to the U.S. Treasury. So, just one more thing before I go on. That allocation methodology will be released in mid-October in the notice of payments that HHS is planning to release. So how the program works is essentially, as I said, a stop-loss insurance pool, and payments will be made based on essentially 3 parameters: the attachment point, the reinsurance cap, and the coinsurance rate. So the attachment point amounts payable under the program that will be eligible to be paid under the program will be between the attachment point and the reinsurance cap. So the attachment point is the point at which claims above that threshold will be eligible for reinsurance payments, and the reinsurance cap will be the limit or the maximum of the claims that will be eligible for payments under the program. And the coinsurance rate will determine the percentage of that eligible amount between the attachment point and the reinsurance cap that will be actually paid out of the reinsurance program.
Ms. James, this is Leslie Johnstone. Can those on the phone make sure you're on mute? We're getting a little feedback. Thank you.
The limit or the maximum of the claims that will be eligible for payments under the program.
Oh, that's me.
The insurance rate will be the percentage.
Takes a while.
With about a minute delay.
Attachment point and the reinsurance cap.
Should I continue?
That will be actually paid out of the reinsurance program.
John, do you have anyone that can check with the audiovisual folks? That'll be pretty distracting.
Well, I think it stopped.
Yeah, I think it
All right,
stopped.
let's try to go ahead.
Thank you, Madam Chair. One thing to note is that the basic structure of this program is not negotiable. And so even if a state is administering the program, the basic structure of determining an attachment point and a reinsurance cap and a coinsurance rate, that is really not negotiable. The levels of those three parameters can be determined by the state, but the basic structure cannot be changed. So in Table 5, I thought it was important to include some basic dates that would be important if we contemplate a state-administered reinsurance program. As I have mentioned before, in mid-October, HHS would publish advance notice of the benefit and payment parameters with a one-month comment period in mid-November. And then the blueprint and declaration letter, which Mr. Hager mentioned, is due to HHS on November 16th. That's where the state will determine whether or not they plan to administer the risk adjustment and or reinsurance programs. December 1 would be the deadline by which states need to decide whether they are going to collect assessments from fully insured plans or have HHS collect on their behalf, and that's a question that we're going to address in detail just a little bit later on. In mid-January, HHS is scheduled to publish the final notice of benefit and payment parameters, which will be initially released in mid-October of 2012. I also thought it was important to indicate the beginning and end of the 2013 legislative session, just because some of these decisions may need legislative action. And on March 1, states using state-specific reinsurance parameters must publish a notice with the detail of the parameters. Now, the one difference between the reinsurance program and the risk adjustment program is that if a state decides to administer the reinsurance program, they can change the parameters, the attachment point, the coinsurance rate, and the reinsurance cap without prior approval from HHS. That's different than the risk adjustment program, where any change in the federal methodology will have to be pre-approved. Okay, moving on to page 21 and the key decisions for the reinsurance program. The first question is, assuming state administration, once again, I would use the same format that I used with the risk adjustment program and look at the questions that we need to address, assuming state administration of the program before going into whether or not the state should administer the program. So assuming state administration of the transitional reinsurance program, which entity should administer it? Now, I have included state agency as an option. Based on the final regulations regarding these programs, it is not at all clear that the state agency is an option as far as being able to actually run the reinsurance program. But I have included it here because several states have indicated at least some appetite within the state for a state agency such as the state insurance regulatory agency to administer the program. When I spoke to HHS and asked them to clarify the intent of the federal regulation, they indicated that that this question was under legal review and they did not have an answer for me. This is one of the questions that I'd hoped we'd have an answer to prior to this meeting so that we could finalize our report. So I have included the state agency as a and as an option, but I'm not sure that that is actually true. So I wanted to caveat this this part of the report. And my comments here on page 21 that even if a state agency were eligible, the structure, a structure that will allow carriers and self-insured plans to participate directly in the decision-making process or more directly may be more appropriate for this program. However, it may be a little more, it may take a little more creativity to allow transparency of the process and direct participation of the interested parties and stakeholders. If an entity such as the DOI were to administer the program, but it's probably not impossible to do. So one of the other choices would be an existing reinsurance entity. And Table 6 summarizes there is currently a reinsurance entity that administers the reinsurance program for small employers and eligible persons. And this entity essentially carries out a lot of the functions that are similar to what would be contemplated under reinsurance entity administering the transitional reinsurance program. However, there are significant differences between this existing entity and what is contemplated under the Affordable Care Act. So the DOI is currently researching, and this is another area that is unclear as to where we'd end up. The DOI is actually researching whether the ACA's reinsurance program could be administered under the structure already in place under the current reinsurance program. Some of the differences are pretty important. For example, the covenant structure under the current reinsurance program, in keeping with its goals and obligations, the governance structure includes representatives from the fully insured market and does not contemplate representation from the self-insured market. This may be something that if we had a reinsurance entity, representation from self-insured plans may be something that's preferred. So Table 6 on page 22 summarizes some of the differences between the two programs. And of course, the final regulations also contemplate a brand new entity that would administer the program, an entity that's not a state agency that would administer the program, assuming that the only caveat is that it would have to be a not-for-profit entity. So based on the options available, of course, we're not sure that a state agency is a viable option. Based on the options available and the information that we know right now, our recommendation is that if the state were to decide to administer the transitional reinsurance program, we would recommend that a nonprofit entity be established with a governance structure that includes representatives from all sectors of the health insurance market, or the health insurance market, including self-insureds. And so there would be quite a few issues to iron out if if we were to go down that route. But again, our recommendation, if the state were to implement the transitional reinsurance market based on what we know now, knowing that there are a couple key questions that we really don't have answers to yet, which may change our recommendation. Our current recommendation is that a brand new nonprofit entity be established. Moving on to the question regarding should the state collect reinsurance assessments from commercial insurers or defer to HHS? And this again is assuming state administration of the program. So the background behind this question is that our final federal regulations provide that HHS will collect reinsurance assessments from the self-insured market. And this is because states do not, and ours in particular, does not have the authority to collect from the self-insured market. We have no jurisdiction over the self-insured market. And so that provided states with a little bit of conflict as to how they could implement this program without the ability to collect assessments required under this program. So in the final rules, HHS decided that they will collect the assessments on behalf of self-insured plans and leaves it up to states as to whether the state will collect from the fully insured market or defer that also to HHS. And our recommendation right now is that since HHS would already be collecting assessments from self-funded plans, and self-funded plans represent 2/3 of the healthcare market, it seems to be administratively efficient to allow HHS to collect assessments from the fully insured market as well. And so under this scenario, HHS would collect the assessments from all contributing entities and remit those funds to the applicable reinsurance entity that will be defined by the state. So our recommendation is that Nevada defer all assessment collection responsibilities to HHS because it is administratively efficient. Any additional assessments in excess of the national rate plus expenses would have to be collected by the state. That is one of the stipulations in the final regulations. So the national assessment takes care of the benefits that would be payable under this program, and then on top of that, the state is allowed to charge administrative expenses. HHS would collect those two pieces. However, if a state decided to charge an additional assessment to fund benefits in excess of what could be funded by the national assessment rate, then that additional assessment would have to be collected by the state. Going on to the last question that the state will have to answer regarding the administration of the transitional reinsurance program. Should the state administer the transitional reinsurance program or defer to HHS? The final regulations, as I said before, allow states to determine whether or not to administer this transitional reinsurance program, which I should remind everyone is a 3-year program, or defer administration to HHS. So some of the considerations that we looked at was state flexibility. If HHS administers a program, all reinsurance parameters will be determined by HHS. There'll be no flexibility at all and all functions of the reinsurance program will be federally administered. So one of the questions, the bottom line here is how important is state flexibility from an operational and policy perspective. The amount of benefits paid out is directly related to the parameters, the attachment point, the reinsurance cap, and the coinsurance rate. And so if the feds administer the program, there is no flexibility as far as the state is concerned regarding how much benefits they would pay out. The only thing determining the benefits paid out is how much money is actually poured into the system through the federally determined assessment rates. So going on to administrative efficiency, again, similar to the risk adjustment program, one could conclude that federal administration of the reinsurance program may be more administratively efficient and allows for the state to focus on its core responsibilities with respect to implementation of healthcare reform. That's definitely a consideration. The state would have to weigh the flexibility concerns versus the administrative efficiency benefits. The cost of implementation and maintenance of the program, of course, we don't know what that is yet. From the HHS perspective, we expect to get information on that in mid-October of this year. And at that time, we'll be in a better position to compare the cost of the federal administration versus state-based administration. That said, going down to the next item, given that the state already has experience with administering the reinsurance program, it's a lot lighter lift than would be the risk adjustment program, where we really don't have much experience administering the risk adjustment program. So moving on to page 25, one of the other considerations is the ability of the state to leverage existing infrastructure. It boils down to really two questions, and that is, first, as I just mentioned, can we leverage off of the current structure in place for the reinsurance program for small employers and eligible persons? Can we leverage off of that structure when implementing the transitional reinsurance entity, or would a new entity need to be established? As I said before, we are currently researching that issue. And the second is, and this is something that I did get some clarification from HHS on this, can the infrastructure created by HHS for the risk adjustment program, in particular the use of the dedicated server, a computer server, and use of standard data format, can that be used by states in administering the transitional reinsurance program? And the answer I got from HHS is really it's a decision to be made between the state and the carriers, because they own the servers. So if a state wanted access to the servers, it would be up to the individual carriers, because right now we do not have legislative authority to access any information from the carriers. So that would be something that would need to be explored should the state decide to go down this road. The timing, there are definitely timing concerns regarding state or federal administration. We have a little more wiggle room because the decision, really, other than the indication that we can that we need to, other than in our declaration letter indicating whether or not we plan to administer the transitional reinsurance program. The real drop dead deadline is March 1st, when we would need to publish a state notice about the details of the reinsurance program. So we have a little more wiggle room. However, it's possible that state implementation of the program would need legislative action. And so the legislative calendar may be an impediment to that process. The last is, but definitely not least, is stakeholder input. We, for the risk adjustment program and the reinsurance program to work, stakeholder input is absolutely crucial to the successful implementation of both of these programs. Since this committee has not yet had the opportunity to explore these questions relating to the transitional reinsurance program, and stakeholders, particularly the self-insured plans, have not had a chance to provide feedback and input on their thoughts, we did not feel like we were in a position to give a recommendation because we had not yet had a chance to consider all perspectives. We believe under the reinsurance program we've had a chance to look at all sides of the issue and give a recommendation we're comfortable with regard to state or federal implementation of the reinsurance program. We really do not feel that we're in that position. So we would like to punt this recommendation until we have further input, and also until we have further clarification from HHS and based on our internal research regarding some of the open questions. Madam Chair, this concludes my report.
Thank you very much, Ms. James. I will open it up to the advisory committee in a minute. First, I'd like to see if there are any public comments for the advisory committee. Those in Carson City?
Nobody's here.
All right. Las Vegas?
Good morning. For the record, my name is Bobette Bond, and I'm representing the Culinary Health Fund this morning as a large self-insurer that operates only in Nevada. We are very concerned about the impact of any additional costs on the self-funded plans, which are all non-for-profit and isolated from being able to participate in the exchanges. So we really appreciate that this report is suggesting more input from the stakeholders, and we have valued how much input you have already tried to solicit from the community. I don't believe the self-funded plans have a formal way to provide input to this committee. I don't think we're participating on the advisory panels, and I don't believe that we have an easy mechanism. So my first point is I would really like, on behalf of the Culinary Health Fund, to have an opportunity to provide formal input to the recommendations. And secondly, to just put on the record a placeholder saying that we don't believe that when you make these decisions, the self-funded plans should be held to the same financial impact as the plans that can participate on the exchanges. We believe that the decision to fund the exchanges through the plans that are participating in the exchanges was a good one on sort of the taxation premium issue, and we believe that should be extended to all aspects of the exchange since we can't participate. We understand that there is some fee built into the Affordable Care Act that you can't control. But what we're trying to figure out and would like a dialogue about is how much of that can be either repaid to us or allocated to the players that proportionally that are going to be able to participate in the exchange. And we'd like a chance to dialogue about that.
Thank you. For purposes of full disclosure, this is Leslie Johnstone, and I will just say that in my day job, I work for the Health Services Coalition, which is a nonprofit organization that provides services to self-funded plans in the Las Vegas area. So while I'm very familiar with self-funded plan issues, the Health Services Coalition isn't impacted one way or the other by the recommendations of this committee. So I'll just get that on the record, since Culinary Health Fund happens to be one of the largest members. And at this point, I will then ask if there are any public comments from those on the phone. Hearing none, I'll turn it over to the advisory committee members for discussion on this item.
Ms. Johnstone, this is Barbara Smith-Campbell. I concur with you that Ms. James has given us a very thorough report, and given the last 4 questions, it sounds like they would like to have a little more time and input before they make a definite recommendation. So I would move that we take their recommendation to defer on those 4 questions until they have ample time to answer questions.
Thank you. Is there a second?
I would second that. This is Chuck Tompkinson.
Thank you. So we have a motion and a second to basically hold on this item until we can reconvene after the Division of Insurance has been able to do some additional research and hopefully finalize some recommendations. So with that, all those in favor, John, let's go ahead and take a roll call so we know who's still on the phone.
Mr. Mahoney?
I'm here.
And can we get a yes or a no on the motion, please?
Yes. Yes on the motion.
Mr. Nimmer?
Yes.
Mr. Shaw?
Yes.
Mr. Young?
Yes, and what I'd also like to suggest, too, if we don't already have something like that, is maybe, some sort of like a calendar of, as we're, I think, doing the right level of due diligence with this, that we can maybe get some sense of, when, just to have time to be able to implement, when we need to have decisions by.
We'll do that for the next report. Mr. Tompkinson on the motion?
Yes.
Vice Chair Campbell?
Yes.
Chair Johnstone?
Yes.
And the motion passed unanimously.
All right. Thank you very much. So I'll look to Ms. James to work with Mr. Hager on when it would be appropriate for this advisory committee to reconvene. And we will just need to talk at that point about the transitional reinsurance program.
Thank you, Madam Chair.
Let's see. Thank you. Item 7 is discussion possible action regarding dates, times, and agenda items for future meetings. I think unless we need to take an action, we've pretty much settled what the next item and remaining item of this work of this advisory committee needs to be.
Madam Chair, we don't need an action to set the next agenda. It appears that all we have to talk about at this point is reinsurance. Ms. Cox has sent out a request from the committee members for September and October availability, and so we're going to tentatively schedule a later September and then an October committee meeting, depending on our ability to get information from the feds and our ability to answer those questions will determine whether or not we have a September or October meeting. So we'll get back to you, but we would like to make sure that if you haven't already, please get that availability back to Ms. Cox so we can schedule that as soon as possible, because we realize that everybody's calendars tend to get full One other item for those of you that would like to submit public comment, please provide that to Ms. Cox or myself. You can go on to or you can send it to, I believe it's contact@exchange.nv.gov. Again, that's contact, CONTACT, at exchange.nv.gov, and we can post written public comment with the next agenda and reports for the Reinsurance Committee. So please get that to us so that so that we can hear your voice.
Thank you, Mr. Hager. And I might ask Ms. James to provide similar contact information. There may be public comments or questions or things to be considered as part of the DOI's analysis that individuals want to submit. What would be the best contact source for that, Ms. James?
Let's see. I think they can send an email directly to me, and my email address is ajames@doi.nv.gov, and I will make sure that it gets back to Mr. Hager. But if there are questions that I can respond to directly, I'd be happy to do so.
Thank you very much. So going on to item 8, public comment. Any additional public comment in Carson City? Any additional comment in Las Vegas? And any additional comment from those on the phone? Hearing none, I think we're ready for adjournment. Thank you all very much for your participation.
Thank you.